When I think about banking, I think about loans. If you ask me what does a bank do, I would say they write loans, and that's the core business of a bank. If decentralized finance is attempting to do what banks do, but without the actual bank, then lending and borrowing dApps are of great importance. Remember, loans in decentralized finance are usually over collateralized. Some asset has to be put up to guarantee repayment of the loan. Otherwise, that asset gets forfeited and then liquidated by the lender. What we'll talk about today is not only the idea of lending and borrowing in decentralized finance versus centralized finance, but how NFTs could actually be used as collateral for loans. I Pick Bitcoin will be here with me to talk about what this might look like using NFTs as collateral. I Pick Bitcoin, thanks for coming with all of your traditional finance background. Help me lay out a picture of what NFT lending protocols might look like on the blockchain.
Hey, thanks for having me again.
No problem. If an NFT is an asset, right, then by definition it has value to somebody else. And if it has value, there has to be a way for the owner to unlock some of the value other than simply just selling it to someone else. Is that right? So what's the actual criteria in centralized finance for something to be regarded as collateral? How would that work?
Yeah, so for collateralized lending in traditional finance, right? The collateral, let's just set this straight, is an item of value that a lender can seize from a borrower if they fail to repay a loan, right? So a home, a car becomes collateral, a residual mortgage. This is a type of loan where your house is used as secured collateral. Home
Right.
equity loans, right? Similar to a home loan. Equity loans convert the property's current equity into cash, similar to business loans. So how does margin collateralized lending work in TradeFi? I'll give you an example for brokerage customers, right? And the majority of your listeners probably have a brokerage account.
Right.
A margin agreement, with a margin agreement, you can borrow up to 50% of the purchase price of your investments, any new investment. That means that an investor who uses margin could theoretically buy double the amount of stocks than if they'd only used cash, right? So, for example, if you have $5,000 deposited into your margin account, you can buy up to $10,000 worth of marginable stock. You would use your cash to buy the first 5,000, and your brokerage firm, whoever you signed up with, would lend you another 5,000 for the rest of it. So with marginable stock, you purchased serving as collateral. Your margin would magnify your profits, but they would also magnify your losses in that scenario.
Got it. How would it magnify the losses exactly?
So your losses would be magnified if there's a margin call,
Okay,
right?
okay,
So
okay.
so a brokerage firm requires that margin traders, which that's what you would be considered, would maintain a certain percentage of their equity in the account as collateral against the purchased securities.
So
This is
50%,
you.
right?
It's
Your
usually a little
example is
below,
50%.
like
Okay,
between 30, 35, 40%. Yeah.
okay. Oh, so you
So
start out at 50% and they'll let you float, a little bit lower.
correct. Yeah. So you'll be required to immediately deposit more cash or other marginable securities in your account to bring your equity back up to the required level. So I'll give you an example. Okay. Assume you own $5,000 in stock and buy an additional $5,000 on margin. Your equity in that position is $5,000. That's 10,000 less the $5,000 in margin debt because you borrowed that, right?
Right, right, right.
So that gives you an equity ratio of 50%. If the value of your stock falls to 6,000, your equity would drop to $1,000. $6,000 in stock less the $5,000 in margin debt for your equity ratio of less than 17%. So your brokerage firm requirement is 30%, then the account's minimum equity would be $1,800. That's 30% of $6,000. So you would be required to either deposit cash or other securities to meet that 30% buffer.
Okay.
Or else they're going to liquidate your account. They're going to sell everything in your account, take the cash, so they're whole, and you're left with nothing.
And they make something off that.
They don't make anything. Their job is not to make money in this scenario. Their job is to not lose any money.
Got it. Okay. Okay.
We're never going to look to make money in that scenario. We want to limit our loss. So we're going to liquidate you, take it, sell off the assets that you have, and move on.
Okay. With NFTs, it's a little bit tricky because there's no broker calling you like, hey, you need to deposit more NFTs into your account. This is smart contract. I'm guessing if there was a NFT lending protocol right now, maybe there is, but it would look like something like a Bitcoin liquidation, where if you go like 0.01% below a certain number, you're liquidated and you pay some fees and that's it.
Right. So all the smart contracts that are out there right now in DeFi, there's a number linked to them, right? There's nobody going to call you. There's nobody that's going to try and work out something with you or give you additional days, right? So they're just going to liquidate you. To me, to value an NFT, given that each piece may be different, that's really driven by supply and demand forces, right?
Yeah.
The open market decides what the price should be. What I think should happen is a project can focus on providing a buffer on their floor price by distributing NFTs to non-holders via promotions or marketing efforts, and working with these platforms that are providing loans to back the actual loan. To say like, listen, if one of our clients is holding this NFT and they reach that 50% buffer, give them an extra 5%, we'll cover the difference.
Right.
That's where they can really differentiate themselves, because all these NFT projects, they're all starting to look the same. The ones that are going to step away from them are the ones that are going to differentiate themselves with how they can help their clients. At the end of the day, listen, these are all clients buying your NFTs. What are you doing for them? And if you can't answer that question, your chances are 90% of the time you're going to go out of business in the long term.
Right. You have an NFT mint. People start to lose interest even if you are doing something for them. But I think in your scenario, let's say there's a platform that will lock up an NFT and give you 50% of whatever the floor price is in cryptocurrency. Rather than get liquidated, you have a little bit of a buffer, like you said. And then the project creators have an agreement with the platform to take the NFT off their hands, so there's no risk there. Is that right?
Right. NFT creators can add utility to NFTs by making them easier to lend. The focus for creators should be to get the NFT in as many wallets as possible. That's the end game for me, right? Concentration is not typically a strong indicator in nothing, even in traditional finance. And if price continues to move up due to some large whales accumulating, that's a huge headwind for non-holders. The focus should always be to have a diverse set of ownership for utility. A lot of people disagree, and the people that disagree are the ones that are probably holding an exorbitant amount of a specific NFT.
They control the floor price.
Right. Once that person turns sour, you can dump the entire project. Right. Yeah. So as an NFT creator, I would have limits. I don't want one person minting 20 NFTs.
Yeah, I mean, let's say I take a loan against my NFT. The floor price is 1,000, right? And as soon as it goes below whatever the buffer zone is, I'm gonna lose my NFT, right? If you have a big percentage of the collection and you know that I'm borrowing against my NFT, you could now flood the market on purpose, drop the floor price, and get me liquidated.
That's right. You know why? Because it's just another trade. And what you're getting is you're getting a lot of people that know how to trade into NFTs. And you, as somebody who doesn't know how to trade, you're going to get liquidated. This is what happened to UST. Nobody attacked UST. Like it was a trade. somebody was smarter than they were, and they put on trades that knew that UST couldn't back. That's all this is. This isn't anything personal in the market. This is all trading.
Right. Well, let's look at the ideal scenario. There's a platform. I have a bunch of NFTs, and I don't want to have to sell them to get liquidity, right? I should be able to borrow against them if they're assets. If they're digital assets, I should be allowed to borrow against them, or someone should be willing to loan me money, loan me cryptocurrency against my NFTs. My NFTs worth 1,000, they're going to give me $500, right? What are the obviously the pro here for the NFT holder is that I've unlocked liquidity without selling my NFT. Is there a pro or are there more cons for the project? How do you see it? The project
listen, as long as everything is humming along,
right,
in an uptrend situation, there's no downside for the NFT holder. But every 5 to 7 years, you have a big bear market, and that's what's happening now. And everybody that lent their NFTs is going to get liquidated because they're not going to be able to meet the cash requirement on it. So it always runs good for a certain amount of time, but when it runs bad, you get liquidated.
Right. And the platform, if they don't have deals with the project creators or somebody else, they're going to get stuck with NFTs that nobody wants, right? Or that no one wants for the price that it was for the at the liquidation. So,
yeah, well, remember, you got to FX it, right? Because let's look about it. 6 months ago, we were looking at these, and 2 ADA was 2 ADA, right? Now it's 0.50, it's 50 cents.
right.
It's more than 50% below on an FX comparable position. So as an NFT creator, you're buying it for less, but if you put it up on the market for more, you're out that money. There's an FX that has to get done on that, right? Because if you bought your NFT and you FX'd, $2,000 to buy an NFT that's worth 4,000 when ADA was at 2 and now it's at 0.50, do the math. How much have you lost? Right? And I don't think enough people take the FX consideration into it.
Yeah, no, I definitely see people that are just, some of the floor prices on the projects have not changed even though tokens have dumped, right?
So what does that tell you? Are people not paying attention?
Not paying attention. Some people, this is what I think. People are minting a whole bunch of NFTs. They think they're going to flip them. They realize they can't. Some people do flip them and they're really good at it. Some people are just good at it. They dump them on the market and they forget about it. And then they're like, oh, I'll just see the money hit my wallet when it sells. And some people are just like, hey, I'm not gonna ever convert to fiat. I just want to just stay in the cryptocurrency. That's fine for them. But lending is different. Lending is going to be different because every NFT in the collection theoretically should have a different value. Right? Every NFT is unique, and if we're going to use the floor price to value them, maybe people that have the highest priced NFTs in the collection might be reluctant to lend them unless they make a special deal with the platform where they say, okay, we're not going to use the floor price, we'll double it because you have this trait on your NFT that's extremely rare.
Hey, let me ask you a question.
Mm-hmm.
NFTs in Cardano, when did they really kick off? At the end of last year.
Yeah.
Right? What was Cardano's
I would say
price
after
at the
Christmas
end of last year?
I would say after Christmas time. Yeah.
What was it? What was its price? So 2021, 2020,
2021.
2021 December.
Yeah. So around $2, right?
Right. So people that were getting into the NFTs then were paying $2 for 1 ADA. Today, that 1 ADA is worth less than 50 cents.
Right. So 75% dump in 6 months.
Right. But they bought it using they bought it using the currency of wherever they're living in. Right.
Yeah.
So FX'd it's dumped how much?
Right. So is the platform going to, back to the NFT lending platform, the platform's going to have to have a way to balance, you know, the native currency or whatever the layer one is that the NFT is typically bought and sold for, and also the fiat currency that they pay their bills in, they pay their developers, things like that.
Right. The good thing about the platform that's actually providing the service is they don't have any FX risk until it actually gets liquidated. Right. So if it gets liquidated today, they need to turn around and sell it, tomorrow or within a few days to make sure that they don't have any exposure. The all the exposure is on the NFT holder because it's not just the ADA amount going down, it's the FX versus your currency that it's being devalued at.
Right. In your example from the beginning, and we can wrap it up in a minute, it's totally different because the person can call you. They're giving you, if you have $5,000, you get $5,000 of margin. You're doubling, right? You're doubling up. With an NFT, it's complete. Well, in decentralized finance, in our example with the NFT, it's totally different. You're getting half, right?
Right.
So even you could be over collateralized and still get liquidated depending on what the terms are in the smart contract. So decentralized finance, I guess that's why we don't see widespread NFT lending. It's probably really hard to figure out, and the assets are liquid. You could liquidate a whole bunch of people, and then so what if no one wants them? You could put them on the market, and they might never sell.
Yeah, that's right. Listen, I think it's a fair business to have. I think you need the business to develop further, right? Whether it's on Cardano or other blockchains, it just needs to mature more, right? And in due time, these industries will mature, right? NFTs are not going away, nowhere close to it. They're only going to get bigger. Me and you talk about this often. NFTs are going to be all over the world. They're only going to get bigger, right?
It's going to
Like
be like
what?
just things that we have, just like we have credit cards and business cards in our wallet. It's just how it's going to be. People will each have their own collection of NFTs for different things. It's just going to happen.
Right. We're just going through an inflation bubble, and this all works in cycles, right? I've been through two of these. You get prices that go down 80, 90%. I'm immune to this. Nothing changes for me. All I think about is how I can buy, assets at a lower price.
Well, I mean, the NFT space is growing despite macro conditions. Then all NFT projects are not growing equally, but overall, it's growing. And I think hopefully we start seeing this, in practical use case of using NFTs as collateral, because I think unlocking liquidity from an NFT is very important for holders, especially on proof of stake chains where you're losing out on staking rewards or DeFi opportunities in any chain to begin with. So anyway, we can wrap it up here. I think that was really good. Maybe in a couple months when we start seeing some platforms being used, we could follow up on this. But I really appreciate it.
Listen, thanks, but I think you're going to see some downtime because there's people that are not well collateralized. You're going to see a lot of funds go out of business, right, over the next 6, 12 months because of what's happening with inflation, right, and the rates rising, and they're not going to be able to keep up.
Well, anyway, good talking about this, and see you next time.
Talk to you soon.